All right, all right. Good morning, good morning. How are you guys today? What an amazing day. Started to warm up here. How about you guys? You getting a little heat where you're at, a little warmer where you're at here in St. George, where we're at down here in southern Utah. I walked around yesterday, went for a walk without my jacket on. How about that? Short sleeves and, well, it wasn't shorts, but short sleeves and long pants. Went for a nice long walk. I didn't even feel like I had to run back to the car to get warm. So things are starting to turn the corner here. I noticed that they started putting sprinklers on the golf course. So things are starting to warm up. All right, what are we going to talk about today? We're going to review our portfolio. We're going to talk a little bit about accumulation, distribution, and we're also going to talk a little bit about the out on the little marquee out front. It said that we were going to talk about intrinsic and extrinsic value. So we need to touch on that today. We've also got a bunch of new students who are coming from the university. So we need to accommodate them and talk about some of the things we've been talking about in class. So we're going to a little bit of do that, but we're going to do that all in the process of looking at our portfolio. All right, so we're going to go out and look at the stock market portfolio. And if you don't have the software I'm using, you can go get it over at trackandtrade.com. Just type that in there, and we're going to be using the stocks version today. So grab that, download it, and then your charts will look like mine. All right, so it's a 6-time stocks. Actually, it's a 7-time Stocks and Commodities Annual Reader's Choice Award winning platform. So it's very well known in the industry. People love it. So if you need a platform, this is a good one. Go get it. So when I use, and then you can use all the same settings and all the same indicators and all the same views and looks and strategies that I use here. It's the best way if you want my help for me to be able to help you. All right, so that is that, and that's the software we're using. So go ahead and download that and let me know if you need some help. All right, so the first thing I want to do is I want to go over and look at the news, because the news just broke. At 8 o'clock a.m., we had the ISM Manufacturing PMI, Purchasing Managers Index. So forecast was 49.8. The actual was 50.9. So that's actually good news. Is it good enough news? Well, the consensus was 49.8. The previous was 49.3, and it hit 50. So that's actually better than the consensus, better than the forecast. Is that going to make the market go up or down? Who knows? Nobody knows. It's red. It says it's supposed to, but we don't know. All we know is it was going to make the market move. Which market? Well, whatever market it affects. Well, all the stock markets. We can go look at the SPY, which is the S&P 500, and the market flushed today. There you go. You get good news, and the market still can flush. So that's how it works. We don't know, and I always say this, we don't know if the news is going to make the market go up or down. So we don't know. We just know it's going to move the market. So generally the market's going to move. Whether it goes up or down, that's for the big boys to decide, whether they decide it's good enough news. Even if it says on that little report, it said it was better news than they expected, well, market's still flushed. But that's not necessarily because of that news event, right? Because this market's flushed before the news event came out. So we also have a lot of scare factor going on right now, because today is Monday, and it's the day that all the tariffs go into effect on Canada and Mexico and China. So, a lot of people are a little worried about that. I don't know. Do you think we should worry much about it? Think it's going to be better or worse? Probably in the short term, it'll probably raise prices a little bit as they fight things out. And if prices go up a little bit for the things that they put tariffs on, and then they lower taxes because they can get money from the imports as opposed to the products, does it really make a difference? And I think that's kind of what Trump's going for, right? I think that's his plan. It's kind of what he said all along. He's like, I'm going to tariff these countries, take money from them, and then we're going to be able to keep the taxes low on the American people. And wouldn't it be nice if we could just completely and totally eliminate the IRS, which is what we have. I mean, it's in the Constitution that they're not supposed to have an IRS, right? They changed that with an amendment back in, what was it, 1913 or something, 1930 or something, like 1930. They changed the IRS and created an IRS so that they could tax the American populace instead of tax the world populace. And so that's how we've gone from a tariff country where we had no income tax. I mean, we didn't you learn in high school about the Boston Tea Party? I mean, that was a pretty popular thing, right? Why did they throw all the tea in the ocean? Well, in the bay, they threw it in the ocean because they didn't want taxes on it. There was no taxes in America forever. I mean, if you go read the Constitution, those of you who are constitutionalists, you know that it says right in the Constitution that there are no taxes, there are no income taxes in America. And it was like that clear till like I think 1930 or something. And then they taxed everybody and decided that, oh, that's a good idea. And then we won't tax the world, we'll just tax the people. And they switched it from so that we could move into a globalist economy. And that's when all the problems started. And that's when our debt started to go through the roof. But anyway, nonetheless, that's the whole idea. That's Trump's idea. He thinks that we're going to go back to a tariff country and we can lower taxes. And so that's why he makes all these promises. He's like, well, I can promise you that we're not going to have Social Security is not going to go out of business. Social Security is not going to be taxed. We're not going to have tax on tips. We're going to lower your taxes, make taxes lower because we're going to tax all the imports. And if you don't want your imports taxed, well, come and make your stuff here. Doesn't mean you have to stop making it in the country you're in. Just come and start a factory here and make your stuff here. And then it's not taxed. And so that's the idea. And is it going to work? Well, it's going to take time. It's not going to happen overnight. I find the mainstream media just hilarious. Those guys are just the most stupid people you ever saw in the world. They're all like blaming Trump because eggs are expensive. I've been in office eight days, and it's my fault that the eggs are still expensive. That's the brain power of our mainstream media. Anyway, I'm not here to talk politics. I'm here to talk about the markets. Let's come in and look at the markets. Oftentimes, politics and the markets kind of run hand in hand, though. And we're all a bunch of news hounds, aren't we? We all love the news. We like to sit and watch the news. And here, this is the lab for the university. And so I always tell people in class, I said, all right, we're here in class. And people start asking questions. And I'm like, that's a great question, but it's beyond the scope of this class. So that's a rabbit hole that would be fun to go down, but not here in class. On class, we got to kind of stay focused, and we've only got a short amount of time to go a long ways. Here on YouTube, this is the lab, and I always tell people, you want to go down rabbit holes? We'll go down rabbit holes on the lab. So come to the lab, and you can ask any question you want. We'll spend, stupid amounts of time on stupid things because they're fun. It's fun to talk about. So that's what we do here on the lab. We go down deep rabbit holes, and we'll spend a lot of time talking about crazy stuff, just for fun. All right. That's what we could do here. We come here and we come in here every day and we watch the markets and talk and have fun and go down rabbit holes. But look at the market flush. It's flushing like crazy. We're going to come in here. We can go down to a shorter term time frame. Let's just go down to a 15-minute chart and see what it's been doing. And it just flushed. It had a big old gap down. Let's turn on our Heiken-Ashies. You can see it just gap down. But is it freaking us out? Maybe a little bit, but hey, it's giving you the opportunity to buy low, sell high, right? If the market pulls back a little bit in here, we got a nice long trend line. You can see that natural trend line, and we had 3 drives in there. If we turn on, oh God, it's kind of, you can see the 3 drives without turning on the lights. There's drive 1, there's drive 2, there's drive 3, right? So we all know that 3 drives is an Elliott wave, and an Elliott wave is the probability that the market's not going to go much higher. So then you get the high right up in here. And so if we come in here and the high comes right in there, technically speaking, this market should give us an ABC. And so this, you can blame it on the tariffs. You can blame it on whatever fundamentals you want. But nonetheless, technically speaking, this market should be blowing off and coming back down here to the red line. That's what this mathematical model is telling us anyway. So we're already at the top of a 3rd drive. An ABC top is not going to break higher. It's going to come back down to the red line. And it may even break that red line because this centerpiece already came to the red line. So, and we could have said, hey, this is the ABC right here. Hindsight's 2020. You could have come in and said, well, there's your ABC. And it already came down to the red line. And that, look, it touched like a train on rails right there at the 100%, right on the red line. So it's already done one ABC. And of course, it's got another one in there because markets do that, right? They go up and down, they go up and down. They don't go straight up and down. So you got another little ABC in there. And if you measure that one, it came right back down to that 100% right at the red line too. So both those mathematical models all work. So does that mean this third mathematical model is going to work and it's going to come back down to the red line? Possibly. Nobody knows until after the fact, right? But that's what it's telling us. It's telling us that if you go for the longer term mathematical Fibonacci projection model, it's saying that it should come back down here to the red line one more time. Is it going to do that? We don't know. It could have gone up and started a new Darvas box after this, and we'd have said, well, look, it worked. It came down to the red line, it went up, started a new Darvas box. What's a new Darvas box? Well, once you get the high of 3-drive pattern, we try and start a new Darvas box. We say, well, this is the next 3-drive pattern going up into here. We'd come down, back up, and then we'd expect it to come up, down, and then back up like this. And this would be your Fibonacci projection up instead of down. So we'd take this 100%, go up here, come down to where it establishes a low, which we don't know where that's going to be, like down in here somewhere, maybe 100%, maybe 50%, maybe 61.8, which is the Fibonacci golden ratio, and we put it right there. And we say, boop, just like that. And that's where that comes down. That's almost there right now. It's just coming down a little faster. But we'd come down, then we'd expect it to go back up, right? And then back up into the next Darvas box. How big is that Darvas box going to be? We don't know. But we could go look at the old one and see what the old one was and make it the same size. So if this is the old Darvas box, come on, stop doing that to me. Because we come down here and we say, well, this is the old Darvas box. Let's come in here and make it this big. Well, we could say the next Darvas box might be the same size. Past performance not necessarily indicative of future results, but it's the best we got. So there you go. That's kind of the model that what we're talking about right now. If things keep going well and the U.S. economy starts to grow and grows up, that's where we'd expect. Come back in here, give us a little pullback, and then rally and take off and go back up into this next Darvas box. All right, so that is kind of the strategy we're looking at here on the overall longer-term market. That's the S&P 500. But we're trading individual stocks. So let's come in and look at some of the individual stocks we got going. This is Land's Richie Rich. I'm going to go ahead and delete that out of here because it's not part of this portfolio. This is Land's Richie Rich Fund, and we got 30 stocks in this. So we got 10 are the very first, and then 20, and then 30. So 10, 10, 10. But that makes 10, 20, 30, right? So there's 10 in each one. So this is the first 10, and we got some, we're not doing well on this one. This is Broadcom, and we've got an order in here to buy 100 shares if the market will close underneath that red line. So the whole idea here is we sold an option. We collected $585. It's currently $177.50 against us, but that doesn't really mean anything because that's only if we liquidate it early. If we bail out of our agreement. Our agreement was that we would buy 100 shares at that price if it hit the purple line underneath our red line. That's really the game we're playing with these options, all right? So we're going to collect $585, but if the market comes back down, we might have to buy 100 shares at that red line. Where does the loss come in? Where the loss comes in if we have to buy the 100 shares and the market's way down here. Market's way down there, well, we have to buy 100 shares there, and the distance between where we bought the shares at that red line, which is what they paid us $585 to promise that we would do, and then the market really comes down here, we'd be down $7,000. That'd be a $7,000 drawdown because we have to buy 100 shares. That's what an option is. That's why they're going to pay us $585 to put this in there, because there's the chance that it could come down here and we'd have to buy it way down here at 7,000. Now we don't have to. We could roll it down. There's little tips and tricks and techniques that we can do so that we don't get ourselves, a $7,000 loss. We could, scoot it down a little bit and play some games with them. But nonetheless, that's kind of the idea, right? But we wouldn't mind having some shares of Broadcom right in here because this has the same concept as what we just talked about, right? So we could come in here and we could say, well, this is our next Darvas box. Broadcom's just kind of been going sideways. Kind of crazy. But the reason that we have this Land's Richie Rich Fund is because these stocks, not growth stocks, these stocks are high dividend stocks. All right. They have high dividends on them. So you kind of want to own these so you can get the dividends, but you want the growth too. So you don't want to just be buying randomly into a stock because it has high dividends. You want to play the growth, right? the growth of the stock as well. So you want to buy low, sell high, and then you want to hang on to them at least a year. Once you get into these, you kind of want to hang on to them once you have the shares, because then you don't get this taxable event. If you don't care about taxable events, then you don't have to hang on to them for a year. The problem is when you're doing individual stocks like this, the dividends are not high enough that it almost makes it not worth holding on to try and hang on to say, well, my taxes are going to be this, my taxes are going to be that. It's like, and I'm going to get my dividends here and my dividends there, but the dividends are so small, even the ones that have large dividends in stocks, individual stocks, the dividends are so small that yeah, you don't really you don't want to sit and go through a $7,000 drawdown so that you can avoid paying taxes and avoid and so you can get your $39 dividend. So you have to play the stock market anyway. You still have to buy low, sell high, even when you're trading individual stocks for their dividends. Now, that said, we're going to talk about dividends from uh, other types of markets, some ETFs that have much higher dividends, and you really kind of don't want to sell those. You really do want to just kind of hang on to them through the duration because the dividends are so high that they're going to pay you back the loss in the NAV. So those are some different funds that we're going to talk about. So there's different strategies for different things that you're going to do. And that's kind of what we're talking about in class tonight at the university. So if you're local and you haven't signed up for the class tonight, go do that. You'll need you to come into that class so you can understand the concept between those two. Trading individual stocks with dividends versus trading ETFs with high dividends. All right. So let's come in and look at the next one. That's Avgo. We're just down a little bit in a little drawdown. We're not worried about it. $192. That's not going to hurt us at all. And besides, we got $585 that we're going to collect against this thing and just haven't got the stocks yet. Let's look at Microsoft. Oh my goodness, look at that baby flush. Now, let's come down here and go to charts. Now, we put on a hedge. All right, we hedged this one because we did the same thing. We sold this one. We're going to collect $660, but look, it's already come down here and actually has the stock is falling down below the red line. So right now, if we got assigned, we'd have to buy these shares and we'd be down $600, $700. So we'd be down about $700 if we had to buy the shares right now. That's if it touched the purple line. Now we could get assigned early, but pretty rare. But it's going to, if it touches the red line right there where it's at, or the purple line right where it's at underneath the red line, well, we would have to buy the 100 shares and we'd be down $700, but we'd collect 660. So in reality, we'd only be down 660. We'd only be down $40, $47, right? So not too bad right now because we got this little buffer of 660 in there. But we're kind of right there right now. We're kind of chewed up our buffer. So we put on here, because this market started to flush, we put on this this hedge. Now we were a day late on the hedge. I know we didn't put the hedge on until the market actually fell. You kind of should put your hedges on if you don't think the market's going to continue to rally. You should kind of put your hedges on before the market flushes. But hindsight's 2020. You didn't know the market was going to flush. You started it was going to go up. Otherwise, you wouldn't have put on a long position, which is what selling a put option is. So we've got in here a hedge to protect us to the downside. And a good thing we did put that on there, because you can see that our hedge right now is up 475 on one and up 110 on the other. So what we did is we bought a put. Now, we bought a put deep in the money, and we paid a little bit for it, $3,600. We did that because it increases the delta. So if you put the money, if you buy a put right at the money, well, the delta is a 0.50, which means you're only going to make 50 cents for every dollar that your position loses. Okay. So if the market starts to go down, you're only going to make 50 cents for every dollar that it loses. So if you go deeper in the money, yeah, the premium costs you more. But then if the market drops, and we put this in here at a delta of, it's right now at a delta of 87, which means we're going to get 87 cents for every dollar that the market falls. And that's a lot better. It costs us more money, but we got to keep that money because it's our money anyway. And then we have a delta of 88. Now, you could have come down here and just bought two at the money options, which have a delta 50. That would have given you a delta of 100, right? That would have given you what we call a perfect hedge. You'd had a delta of 100 against a falling market of a dollar of 100. So you'd had a perfect hedge. But in reality, because of convexity, right? Remember, convexity makes that delta increase or decrease in value one direction or the other. So if the market started to fall and you had two options at the money, your delta would have increased above 100. You'd have had a delta of about 110, 120, right? 130 as that market flushes. You'd be making all kinds of money hand over fist because you got short positions on against your long position, and you'd be making way more than $1 that's being lost on the long position, and you'd be making the short position. But it costs you a lot of money to do that. And you know, the deep in the money option costs you about the same though. So it's just kind of whatever you want to do. And then you put on that covered call, which is what we did. We sold a call up there for $530 to help us pay for our deep in the money put option that we bought with a delta of 75.80. And that's how we ended up with a hedge. It's just a fun way to hedge. Buy one option instead of two, then put it deep in the money. So now we're up $490 on the put option, and we're up $107 on the call. So the question is, you got to pull that off to get that money, because if the market turns around and starts to go up, that money will disappear real fast, right? So you have to watch your hedge, and that's the name of the game. You got to hedge a little bit to make sure that you're not getting your hiney handed to you when you get into the market. So it's nice to put on a nice little hedge. And you can see that we got a difference between, $37 loser on the Microsoft versus $195 loser on the Abgo. And we didn't hedge the Avgo, but we did hedge the Microsoft. Let's come down to Texas Instruments. It doesn't look like we hedged that one either. No, we got no hedge on that one. And the market's flushing. We didn't put a hedge on. So we could either roll that down or not worry about it, just let it go for a minute and see if it's going to bounce and come back up, or we could put a hedge on. If you think the market's going to continue to flush down, we might want to put a hedge on. So how do you put the hedge on? Well, let's come and do that. We just come in here, and we could do it in a number of ways. Again, we could come in here and just buy a put option. We could buy a put option right here. And we could say, well, let's make it a little longer than 4 days. Let's hedge ourselves for 18 days. And we come in here and we buy a put. We just do it right at the money. And if we did that, we'd be buying it. It costs us $500. Now we received $500. So we're going to be spending the entire amount of money that we received on the put option that we sold and buying a put option as the hedge. So that's kind of not going to do us any good. You might as well just liquidate your position. Not really though, because you got, it's $500 over the next, what have we got? 18 days. So it's not really one-to-one, because you could get out earlier and still get some of your money back. And if the market does fall, it's going to start making as much money as you're losing on the received option. So that would be a nice way to do it, but not really, because you're going to have the delta a little bit different on the deltas. The delta of the one that you sold is going to be greater than the one that you're buying. We could go look at that and see what they are. This is the deltas of our put options, 18 days. And you can see in here, this is the one that we currently have, $510. The delta is 0.47. So it's going to start losing money at a delta of 0.47. And we have in here, where did we put, how come that's not showing up for me? Where is this one here? Buy a put. It should be down here somewhere. Well, that's weird. It's not showing up in my window. Let's see how come. Where is it? It's at 180. Oh, saying it's, well, let's see. That doesn't make sense. I'm buying a put. This is my put. 18 days. 18 days. It should be there. Delete that. Oh, we're putting it right here at the money. Oh, that's because it's at the money. Where's the one that we're in the money? Where's that one? That one's got 46 days. No wonders. I'm getting confused. Okay, it's out here 46 days, not 73 days, land. 46 days. Let's come in here and put me down here, make the screen a little bigger so you can see. So we come down here, and this is 46 days, and it's got a delta of 0.57. So it's making 57 cents for every dollar the market moves right now. And in this case, the market's moving against us, so it's losing 57 cents. In convexity, because we're on the other side, convexity is going to push that down and make it lose more money as we go longer. So we need to get a hedge on there, or we need to have the market turn around and go back up, or we need to roll it, or we don't need to roll it yet. It's getting a little far out there though. We could roll it today. We'd have to take a little bit of a loss if we rolled it. We could do that though. We could do that, or we could come back in here and just put our hedge on. Go to an 18 days and just hedge it for a few days. And again, to hedge it, we just buy a put, and we could buy the put anywhere. We could buy it right there. It's $500, or we could put it in the money. We could come up here and put it in the money. It's going to cost us more money, but it's got a higher delta. Okay, so if we do a delta here, it's 0.48 and it's 500. So if we go up here, see, we could buy two of them down there for $1,000. Up here, this one costs us, there's $900. So same price. Might as well just buy two of them down here. Same price. Just like that. Now you got two hedges to the downside and you're paying $1,000 for them. Or you could buy one put option up here in the money and pay $1,000 for it. But then you can put a covered call. There's no reason you can't put a covered call against these puts. Well, that wouldn't do you any good. I guess it would. You could put your covered call in there. So you could come in here and we just buy this as a hedge in case we think the market's going to continue to fall. And that would protect us to the downside. And we're only doing it for 18 days. And we could find out in the next couple of days if it keeps falling. If it doesn't, you just take it back off and you lose a little bit of your money. The problem is that you're going to pay a lot of this. This premium is going to be really high. The theoretical value is $4.96 and we're selling it, buying it for $5.20. So we're buying it for $50 more than what it's worth for the two of them. Plus we're paying a $20 commission. So we're 50, 60, 70, 80, 90. We're about $100 more in premium in this thing. If it starts to go back up, boom, you're going to lose $100 just that fast because you got that in there built into the premium. Question is, do you think the market's going to continue to fall? Could stop there. But we're going down into the green zone right here on the chalk and money flow. And that's when your end generally start, dollar cost averaging, loading up, getting back in. Who knows? Nobody knows. So you go in there and put those on. Let's go ahead and we'll just mark it into those, see if it'll let us have them. Yeah, so we got a couple of puts in there just in case. We'll watch that just in case, all right? Stop our bleeding from going down. Same thing here. I don't think we need to put anything in. Let's go look at some of these other markets. Look at Apple. Apple's tanking. Apple is going to be affected by the Chinese tariffs. Why? Why? That's a silly question. We all know Apple makes all their products in China. That's why. Trump kept telling them, bring your products to the U.S., build your iPhones in the U.S. And they're like, but Donald, I can build my iPhones in China for $10 and I can sell them here to people in the U.S. for $1,000. Why do you think my stock in my company is so valuable? It's because I have slave labor over in China that I can make iPhones for $10. Who cares if they have to put nets around the windows of the factory because so many people jump out of the windows and try to kill themselves? We don't care. We get our iPhones for $10. Did you know it only costs them $10 to make an iPhone in China? And you know how much they sell them to you for, right? $1,000 for these stupid little things. And they buy them for $10. That's how much it cost them to manufacture them in China, is $10. But Donald. Okay, here we go. Apple's flushing down because they make all their iPhones in China. That's 10%. 10% tariff. And we're not in Apple, of course. How could we take advantage of this? Well, if we think it's going to continue to fall, we can just buy a put option. Okay. And this comes into where intrinsic value and extrinsic value comes into play, which is what we said we were going to talk about today. So intrinsic value and extrinsic value is the intrinsic value is the value of the stock itself, and the extrinsic value is the value that you derive from the stock if you own it. So what we do is we come in here and we sell premium, and we don't actually own the stock if we sell a naked premium. So we collect premium, which is extrinsic value, against something we don't own. Well, how can you do that, Lan? Well, if you just sell a put option, it's called a naked put. And the intrinsic value that you're selling against is actually your own money that's in your account, because you have to put up a performance bond, or what we call margin, to sell an option like this. And that is exactly what you're doing, is you're actually pretending like you own the stock, but you haven't actually bought it, because the money has to sit in your account as a performance bond. And so you are actually having intrinsic value of the stock is actually in your account. And if you don't have that money there, then they don't let you do these shares, right? They don't let you sell the options. And so to collect a premium of $585, that would be your extrinsic value against something you don't own. Well, how can you sell something you don't own, Lan? It's called margin. They let you do that. But you got to have the money in your account to buy it, though, if you actually get exercised against. So that's why you have to have the money in your account, or they don't let you do it, which is actually the intrinsic value. Okay. I know it sounds a little crazy, but if you were to buy the stock itself, that would be your intrinsic value. You'd take the money out of your account and you'd put it into the market, right? You'd own the stock. All right. Well, that makes sense, and it's easy to understand. Oh, I own the stock, therefore I have 100 shares. Therefore, my intrinsic value is whatever the value of those 100 shares are, right? $200 a share. Oh, my value would be $20,000 for 100 shares. So that's your intrinsic value, and that's easy to understand. But the problem is, a lot of people don't understand how you can do a naked put. How can you sell something or sell against something that you don't own? How can you make money or $585 selling puts for a product that you don't own? Well, it's because you're promising to buy the product with money you have in your account, which is the intrinsic value of the stock, which is the value that you're specifying how much you're willing to pay for it, right? So if you're willing to pay, in this case, $196 because it's 196 put, well, we're going to put up our performance bond of margin, however much we need to do, in this case, probably several $1,000s, $2,000 or $3,000. But then we have to have the cash, the extrinsic value, or the intrinsic value, actually, because the extrinsic value is the money we're going to collect, the $585. That's the intrinsic value, extrinsic value. Extrinsic value. So think about intrinsic value is the value of the house in real estate. Extrinsic value is the value of the rent. You're going to rent your house, therefore you get extrinsic value. Intrinsic value is how much the house is worth. Well, how can you have rent on something you don't own? And that's the question, and that's the answer I wanted to give you today. Well, you don't have to own Broadcom to put on a rental property, to call it a rental property, because if you had to buy the house, you could. You're going to rent somebody else out. You ever heard of squatting? I guess we're having problems with squatters around this country because we got, 25 million people come pouring across the border, and they need a house. So they just go find a house that's empty. Oh, you put your house up for sale, got a for sale sign in it, and there's nobody living in it. Well, I'll live in it. So they go move in. Or you have two houses and one of them's empty because, hey, you're not living in it. You're living in your other house this week. Oh, well, I guess I'll live in it. They just go squat in it. They just move in. And so then they have squatters' rights, right? And then it takes you 6 months to get them out because squatters' rights, whatever that is, something made up by some lawyer. But anyway, nonetheless, if you have intrinsic value, then you can you have to have the cash in your account, but you can borrow the cash, so you don't even have to have the full amount, because you can have a margin amount, which is kind of seeming a little crazy, right? You can squat on somebody else's stock and sell positions on it, and you don't even have to have enough money to buy the entire house, because they'll let you do it on margin. What a crazy world. You can be a squatter. So that's what selling premium against selling options premium, collecting premium. We're going to collect rent. We're not going to actually squat in the house ourselves. We're going to rent somebody else's house. And that's a good analogy for you. I love that analogy. We're gonna squat on somebody's house by renting it to somebody, and we're going to collect rent. Why? Right? You got two houses. You're down in St. George. The other one's up in Salt Lake City. And while you're gone, somebody's going to rent your house to some squatter, take the money, and they don't even own the house. You do. but they're going to collect the rent. That's what we're doing. That's exactly what we're doing when we sell puts against the market. We don't even own the house and we're going to sell it. We're going to go rent it out, collect the money. Why? Because, and then we don't even have to have enough money to buy the house because they're going to give it to us on margin. What an amazing world this market is. That's just craziness, but that's how it works. That's intrinsic value and that's extrinsic value. And if you don't have the intrinsic value in the market itself because you didn't buy the shares, well, you got to have the intrinsic value over in the cash to buy the shares, but you actually don't even have to have that because they'll put it for you. They'll give it to you on margin. You can rent somebody else's house you don't even own. That's pretty cool. That's the way we do it. That's how you make money in these markets. And that's how you make a lot of money because that's a lot of leverage. You rent somebody else's house that you don't even own and you get to keep the rental property. You get to keep the rent from renting somebody else's house. And you don't even have enough money you don't even have to have enough money to buy the house. You just have to have the enough money to put the down payment if you did buy the house, right? Because you don't have to buy the entire house. You can go get a loan from the bank. And that's what they're doing. They're giving you a loan, but you don't have to even have the loan. You just have to have the money to buy it, to have the loan in case you needed to buy it. What a crazy market. All right. So that's what we're doing here. We are doing intrinsic value and extrinsic value, and we don't even need to have the full extrinsic value. All we need to have is enough to borrow the extrinsic value. And then you can rent somebody else's house and collect premium on it. All right. Let's go. We looked at Apple and we complained about them. Apple's coming down. This is the 200 period moving average. Is it going to come back down and touch that 200 period moving average? Is that where it's going to catch and hold? Look at this big, long, beautiful green. This market should not be full flushing. Everything here is positive, positive, positive. It's the fundamentals that are knee-jerk reaction. Everybody's all scared about a 5%. About a 5%. This was. I'm trying to find some sort of where the market is paying attention to these lines, but it's not really technical analysis. You can see it's respect in that trend line, but then this one kind of fell, and that's kind of like, where's no respect on that one? No respect on that one at all. Guess like that. It's the best you can do. But we got nothing. We got a 200 period moving average and a Fibonacci projection, and that's all we got on Apple. It might catch right down here. We'll wait for it to come down there. As soon as it gives us the first green candle, well, we want to do it before it gives, we want to sell our options down here. We'll wait for it to come down to that green line, then we'll sell some options against it, all right? AbbVie, they are taking off. They're going to the moon today. They like this. They must make their products in the U.S. What is AbbVie? Let's go find out. What does AbbVie do? We're going to come over here. Let's pull up this one here. And we're going to ask ChatGPT. Do we have ChatGPT over here? ChatGPT. What can I help you with, Lan? What does ABBV ABBVIE Inc. company do? Are they a pharmaceutical? Are they biopharmaceutical company? Developing and commercializing innovative medicines across several therapeutics. The company was spun off from Abbott Laboratories in 2013 as major player in pharmaceutical industry, immunology, oncology, neurosciences, aesthetics, Botox. Oh, there you go. There's where they make all their money right there. Eye care, virology, final strength, dividend focus, competitors, Pfizer, Merck, Bristol Myers, Bristol Myers Squibb, Johnson & Johnson. Would I like more information? Yes, I would. I would like to know where they manufacture their product. Where do they do their manufacturing? Global networks producing biopharmaceuticals worldwide. The company manufactures sites strategically positioned products, alliances, United States, Europe. Europe's not got any tariffs on it yet. Asia, Singapore, Shanghai, China. Puerto Rico. AbbVie has 20 manufacturing facilities worldwide, and only one of them is in China. And that supports the regional pharmaceuticals over in China. So, how about that? That's why this company is taken off. Most of their stuff is made in the US. We like this company. They got some made over in Europe, but they're probably for the European markets. And then even in these biological, that says right here, supports pharmaceutical production chain Shanghai, China, but that's for their probably for their people in China. They've only got one plant in China out of all their plants. Okay, that's good to know. So that's why this market's going up. It's not affected by the tariffs. Can we make any money on it? That's the question. Can we make any money on it? 46, sell a put. We'll buy some shares back down here. Nothing there. We could buy them right at the money, $520. Buy them right at the line, $326. We could buy some shares right there if they'd let us. Otherwise, we'll get $500 or $300. We could put it right at the money. I'll just mark it into that one. See if they let us have that one. That's $530 that we just added to the bottom line. And we like AbbVie. They make all their stuff mostly in the US and the UK. There you go. That's still on the 10. Let's go look at Chevron. Chevron's flushing like a toilet. Let's wait for it to come down a little bit more. It's there at the red line. Are they going to make money? Are they going to make money? Is Chevron going to make money? They're going to be able to drill more, but they're generally the product that they're producing should go down in value if they drill more. I don't know. I always want to hold on to these energy stocks. I'm not exactly sure. Any of you guys got any good ideas on energy stocks and whether you think they're going to go up or down in value? If they can drill a whole lot more and the price of gasoline, crude oil, all those things go down, do their companies make more money when the prices are low, or do they generally go along with crude oil? If you go look at crude oil goes up, CVX goes up, crude oil goes down, CVX goes down. Same with ExxonMobil. You almost just figure that they're like crude oil. So I'm a little hesitant on this one. Home Depot, I want to buy. I want to get into it. Why do you want Home Depot, Lan? Because it's coming into springtime, and lots of people like to go to Home Depot and buy all their stuff to go fix up their houses that all got deteriorated and destroyed in the wintertime. And if you rent a house, you know all about that because your rental property is now deteriorated and you have to go fix it all up. That's why I hate my rental properties. You guys know I don't like my rental properties. I am not happy with being in the real estate industry. Not now that I can make all this money in the stock market. But the stocks are flushing right now, so we need to be patient. Need to be patient. And I am not patient. I hate being patient. Why have we got that labeled as an X1? I guess it is an X1 to the upside, isn't it? It's X3, A1, A2, A3. Well, look at that. Man, that's just like a train on rails, just like we said, just like we predicted. Now that's an X1. Now the question is, how far is that going to flush? Probably back to the red line. I think we should put on an order right here. I think we should squat on this. What do you guys think? You want to squat on this one? We're going to sell a put right here at the red line. Let's rent out some Home Depot that we don't even own for $1,000, $1,100. All right, there you go. We just bought that baby. That was stupid. Look at the spread on that thing, $135. Man alive. Johnston and Johnston. Well, that's going into the A3. We're looking for the B1 drive. We need that one. We're gonna wait on that one. Let's go to Microsoft. We already looked at Microsoft. Let's go to Pfizer. Not real thrilled about being in Pfizer. Why? Because it's just got a bad reputation. Because we've all got Pfizer running through our arms. Our bloodstreams are full of Pfizer right now. Oh, that's Pepsi. That's not Pfizer. We got that running through our bloodstreams too. In the form of Mountain Dew for me. Pepsi makes Mountain Dew, right? Let's see. So we do need it to pull back a little bit. So we're gonna be patient on this one. We got to wait. Let's wait for the market to drop a little bit. We need it to break those yellow dots, come down, break the blue dots. Then we can put on an order. We need this to come back down into the green zone a little bit. It might not come back too far. It might get if something like this. This is what we at least want to see, something like this. See that? We want to see that right here, right about here. Just a little green, and then we'll sell some options in there and anticipate the next rise in price on Pepsi. Procter & Gamble. Oh, that looks good. Procter & Gamble. Should we go just for fun? How do you guys know where Procter & Gamble, all their factories are? What is Procter? How do you spell Procter? Porcter. And Gamble primary product line. What do they make? We know Procter & Gamble makes like everything in the world, right? But what do they primarily make? Hair care, Pantene, Head and Shoulders, Herbal Essence, Skin and Personal Care, oil of Olay, Old Spice. I know you guys, everybody in here, you guys all put on Old Spice. Our group's an Old Spice group. Safeguard, Native Secret, Grooming, Razors and Blades, Gillette. Did you know that Procter and Gamble is Gillette? Shaving creams, Gillette, Healthcare, Oral Care, Oral-B, Fixodent, Crest. Now I know Crest is made in the U.S. Over-the-counter medicines and supplies like Vicks, Metamucil, Pepsi-Bismol, Align, and I know you guys, you're all drinking Metamucil. I know what our group is. Fabric and home care, laundry detergent, Tide. That's who make Procter & Gamble makes Tide and Gain, Downy, Bouncer, home cleaning, Mr. Clean. So angry, he pulled all his hair out. Diapers and baby wipes, Pampers and Loves. Some of we all know these. Product supplies, Bounty, Chairman, Puffs. All right, let's find out where they manufacture most of this stuff. Where are their manufacturing plants primary located? Are they U.S.? Are they going to get hit by the tariffs? Global manufacturer, of course, strategically located across the United States, Europe, Asia, and Latin America. Primary market, United States. P&G has several large-scale production plants across the U.S., including Ohio, Georgia, Missouri, North Carolina. They do a lot of manufacturing. We make here in Utah, Bear River City. They make Bounty, and they have a big factory up in Utah, here in Utah. Germany, United Kingdom, France, Italy, Hungary, Asia. Here we go. China, major production hubs for the Asian market, but that's for the Asian market. India, Pampers, Whispers, and Tide. India is not affected by the tariffs. Japan, personal care products. Saudi Arabia, Latin America, there we go. Mexico. Mexico. They don't make anything in Canada, though. Operates 100 manufacturing worldwide. Plants are regionally located to minimize logistics costs and improve efficiency. The company has shifted more sustainable products using renewable energy and waste products. Mexico, large scale production of household and personal care products. So a little bit in Mexico, but for the most part, they have look at all their factories in the US. Good for you, boys. Nice job, Procter and Gamble. All right, they're avoiding the tariffs, pretty much. Where are we at on here? Not really going to buy right now because this is an X. This is an X1S/A1, right? X1S/A1. And if that's the case, that right there is an A2. Might as well label them while we're here. A2, and that right there is an A3. And I don't really want to get into a new position in a market on an A3. Why? Because the probabilities are low that it's going to continue high enough to get to the point where it's going to make you any money before it turns around and creates a, what would you call that? An X1. And an X1. So then we come in here, and that's an X1. And then that's going to be where we're going to get a little bit of a pullback in here. We're going to anticipate, give ourselves an A, B, C, D pattern. I don't know about this thing, though. We're going to do it like that. That's going to, look at that, 61.8, like a train on rails. And then it's going to turn around and come back, break those blue lights, and go to the moon just like this. Boom, boom. Well, it might come up a little higher. 61.8 is where it's at now. It's trying to break that 61.8. It's going to be able to do it and go to 78.6. Let's just assume it's going to go to 76.4 before it breaks and comes back down, breaks those blue lights. That's where it's going to go again. So again, we got to be patient. We got to be patient on Procter and Gamble. All right, we're going to wait for it to make a B1 right in here. Dun, dun, dun. B1, not a B11, B1. So our first green candle to make a new high. Let's get rid of some of these. First green candle to make a new high once we break the blue lights. That is where we're going to get a long position. Whether it is we rent out the house that we don't own by selling a put, collecting premium, or just buying 100 shares or 1,000 shares or 10 million shares or whatever you can afford, that's where you want to buy some Procter and Gamble, some PG&E, some P&G. Not PG&E, something else. And that would be good. Yeah, we could do that. Let's wait for it to come back to us, though. We'll get a lot bigger, fat, fluffy premiums if we wait for it. If we do it right now, our premiums will be a little bit small. Okay. So let's go to the next thing. We're going to go to the next 10 and look at the next 10. This is Caterpillar. Ooh, look at Caterpillar. That's right where we want it. Oh, yeah, baby. Let's come in here and make some money. 46. Sell, sell, sell. Sell a put right here. How much is that? $55 on the spread. That sucks. How about we sell that one? We don't make nearly as much money. We want to sell it right there. We sell it at the money? No, sell it right here. All right, that's not bad. $967. I pay $100 in the spread. Wow. Probably better to do this afternoon. Of course, then your premium's going to probably drop by $100 anyway. See that? As your spread goes down, so does your premium. So you're going to pay for it one way or the other. They're going to get their pound of flesh out of you. So you got to do what you got to do. There's $1,000 we just made. All right. Let's see. Let's go on to the next one. Cisco. Nothing. IBM. Wow, wow, wow is all I have to say about IBM. Wow, wow, wow. Wow, wow, wow. That is just one beautiful market. Why is IBM going to the moon? Why are they? They're usually a pretty stable company. They're not a growth company. What did they give away for dividends just for fun? Let's go. Come on. Come on. Come on. Let's go look at IBM dividends. IBM dividends. $1.67 a share. Yeah, but one share is $254. You have to pay $254 to get that $1.67 per share every 3 months. It's not bad though, I mean, $1.67 a share is not bad. You have to put it into the calculator and figure out what the yield is. To put that in and see what the yield on that would be. $100.67 per share quarterly. $254. You have $25,000 at 100 shares. That would be $1,600 every quarter, right? That's not bad. I mean, nothing to sneeze at, especially if the stock's going to the moon. Holy cow, I get an extra bonus of $1,600 every 3 months for 100 shares. Well, the problem with that is we feel like we missed the boat. Kind of don't want to chase a market like that. Just barely broke into that new Darvis box, though, didn't it? Where's the old Darvis box laying? Well, I'd say the old Darvis box was right back here, from here to here. Kind of went right here, didn't it? And then it flushed back, gave us the ABC, broke, gave us another ABC. That Darvis box is like, it's struggling. Let's start it right. I don't know, it should actually start right here. But it kept going back, didn't stay up there. Oh, let's put this back here. I think we got this little tool here called clone the drawing. So there, we put that like that. That's the next Darvis box. So it came back into Nowheresville here, technically speaking. I guess your Darvis box should come all the way out to here. But not really. I mean, that peak right there, and then it doubled there, and then it broke it there. I don't know. Where do you want to put your Darvis box? It just failed twice, though. There's your other Darvis box right there. So well, let's put it right here. Let's just say that's where it's going to go up there. And no, let's not do that. Let's put it back here because it can fall out of your Darvis box. It doesn't have to stay out. Let's call this the ABC pattern. That's the Darvis box. And then this is where we're at. So if that's what that is, that's going to be an A1 right there. So this is our A1 of the new Darvis box. A1 right there. Boom, boom, boom. So that baby took off. So this little pullback right here, this is A2. What are you talking about, Lan? I'm new to this class. I don't know what you're talking about with A1s, A2s, X1s, X1S, A1. Of course you don't know what you're talking about because you haven't got my book. You have to go get the manual. What's the manual? Well, it's the manual to the class. Just go get the manual to the class, and all these probability tables and all these trend lines and all this stuff is in the manual. It's a 238-page manual. You get it on Amazon. It's printed version. There it is. Just go search Lan H. Turner. Don't forget to put the H in there. You won't find me because I'm not famous. So you have to put Lan H. Turner. Otherwise, you're going to get a whole bunch of pretty pictures of a gorgeous woman named Lana Turner. All right? And you don't want that. You want this stock market playbook of strategies. Search Lan H. Turner on Amazon, pick that book up, and then you'll have 238 full color pages of a book that tells you all of these strategies. All right. That's where you know. That's how you learn. You got to learn. You got to learn about probabilities. Trading the financial markets is like playing blackjack in Las Vegas. And if you don't know the rules for blackjack, you got no business sitting at the blackjack table. Same as the stock market. If you don't know the probabilities of trading the stock market, you ain't got no business trading the stock market. Okay, so go get the probability tables that are in that book. So that's the A1, and that's how we count them. A1, A2. What's the probability of coming into an A2 and having it go up? It's pretty good. It's not bad. You can get into a new position on an A2 if you want to. I'm generally careful on that one because A3 is the next one, and A3 is the one that generally fails on us, right? A2 doesn't generally fail, but this is kind of an extension. I mean, this is a big A3, so it makes you a little scared to get into this one. We could turn on the Bulls and Bears blue light system because it tells us, look at how far back those blue lights are. Wow. And those blue lights and yellow lights have to kind of converge for that thing to break down and make ourselves a B1, which is out here. B1, that would be your B1 probability. And that's the one we really like to get in on. We really want to get in on B1. That's our favorite. That's our favorite probability. And that means that this market would come like this. It would come up from there, come back down, make a little pullback, little A, B, C, D pattern, right? Oh, come on, my heck. And then this would come down in here. And this is where we would end up getting our B1 for the next drive high. So we wait for this to pull back. Then we sell some options against it, get assigned some shares at a good price, and then the market takes off with all of our shares. If it takes off before we get our shares assigned to us, that's okay too, because then we get the consolation prize of the premium. And we don't get a lot of assignments because we're so damn good at figuring out where these markets are going to go because we have such great probability tables. We don't get assigned a lot of shares. It's very rare that we get assigned, unfortunately, because you make a lot more money if you would. If you would get assigned, you could make a lot more money because you get to sell covered calls against your long position, and that's where you get max profit. JP Morgan Chase. Ooh, wow, look at that baby go. Wow. In the interest of time, I'm not going to spend a whole lot of time on this because we got a little bit of a pullback that we got to see. Where's the blue lights? Boom, boom, boom. Charts, Bulls and Bears, blue light. Oh, look. It's already about ready to kick in for us, make us some money. If that thing would break that blue light, it'd come down. First green candles make a new high. We'd get in on that thing. We'd like that. We'd like that. Yes, we would. We're going to go ahead and wait on that one, and we're going to sell some options down in here from some big fat premiums. All right. Same thing. We already did that one. McDonald's. That's drive 1. This is drive 2. That's why we got this little ABC pattern happening here. This is X2. If that's X1 SA1, this is X2 SA1, that makes this X3 SA1. But that's only if you're looking at the yellow dots. If you're looking at the blue dots, which are actually a little bit more accurate, I must admit, not quite so sensitive. Oh, get out of here. That would actually be like this because we look at the blue lights. Blue lights trump the yellow lights. So that would not be, we don't need that. Dun, dun, dun. So that's your X1 SA1. This is your X2 SA1. That's pretty good probability. It's not an X3 SA1 with a higher probability, but this is a pretty good probability. It's not a king and a jack. This is a 17. This is like having a 10 and a 7. Do you want to hit on it or not? I don't know if I want to hit on a 17. Do you want to trade on a 17? Merck. Did we already look at Merck? We got a position on Merck. Why have we got this? We sold a put and we sold a put. Oh, we just sold another one. I think we like Merck. That's why. We're at an X3 SA1 and then it didn't take off for us. We must like this for some reason. I think we went and looked. Let's go ask ChatGPT. Where are you, ChatGPT? Where, oh, where does Merck and Company manufacture all their products? Where, oh, where does Merck and Company manufacture all their products? Merck has United States primary manufacturing hub. Way to go, Merck. West Point, Pennsylvania. Largest site producing vaccines and biology, vaccine production at Gardasil, Elkton Village, Rohan, New Jersey, Rahway, Danwell, Pennsylvania. Europe, they make a bunch of stuff for them guys over there. Asia, Singapore, Shanghai, China. There you go. Nothing in Canada, nothing. Oh, there's Mexico. There she blows. Solid dose pharmaceuticals, oral solid dose pharmaceuticals, pills. That's kind of a funny way of saying pills. Oral solid dose pharmaceuticals. Why don't you just say that's where we make pills? Vaccine manufacturing, key manufacturing focus. Vaccines primarily in Pennsylvania, North Carolina, Ireland, and Hangzhou, China. So they will have a little bit of their stuff is going to be hit with a 5% tariff. Let's see. Well, we got 2 long positions on this thing. Let's see what happens. AT&T. AT&T. I don't know. That looks like a buy right there. Looks like it's going up into the next zone. Red first green candle. All right, there you go. Let's put a stop order in there. Just in case. There's no reason to take a big risk. If it doesn't take off and go, 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 we'll just get out. Verizon. Haha. Verizon, we could squat on this one. Let's get some rent on on a property we don't even own. That wouldn't be a bad spot. I don't know. $32. Not worth it. It's not worth it. It ain't worth it, Lynn. Why would you do that? Yeah, it's not worth it. Not worth the time of day. That one, ExxonMobil. That one we were a little worried about. I guess we'll see what happens on that one. And then we got 10 more. AMT, Bristol Myers, Intel, JP Morgan. Ooh, there's JP Morgan. Come back to its Fibonacci bow tie. Lockheed Martin. Which ones of these are you guys going to go put on your real money accounts? 3M, Nextra, Nike, Pfizer. There's Pfizer. Starbucks. That is because the price of coffee is going through the moon. But that's funny. Why would price of coffee go through the moon and then suddenly these guys stock go up? That's an inverse relationship. Makes no sense. If your cost of goods goes way up, why would your stock go up? Makes no sense. Illogical. That's coffee people buying into a stock that shouldn't be going up. Schwab and dividend equipment. SCHD. SCHD. Oh, that's our boilerplate. That's where we derived all these Richie Rich funds from. These are all the highest dividends out of the SCHD. That's where we got them. You know my secret. How did you pick all these, Lan? I picked them out of the SCHD. Those guys already picked them for us, and so we just piggybacked on them. All right, and then Union Pacific. Union Pacific. These guys just have good dividends. Let's go see, just for fun. Just for fun. Oh my goodness, how come that didn't pull up? How come that didn't pull up? What is wrong? Okay, we got to go here. UNP. UNP's dividends are $1.34 a share. And their shares are $242. So $24,000 every 3 months, you get a $1,340. That's pretty cool. Can't stick that in your eye. Not the best, though. I can show you way better. Yes, I can. Not really thrilled about that one either. Got kind of a weird, look at that big bottoming tail on it. All right, that's it. And that's all we got. Do you know what? I think did we get paid some dividends? Do we get to go to our UBI calculator? And I think we do. I think we got some money we got to put in here. So let's go do that before we let you go. I got a Sunday school lesson for you, so stick around to the Sunday school lesson. Here's Y mags. Today, I think did we already put them in? We might have already put them in. Oh, we might have already put them in. Nope. Y mags 113 was last time recorded. And we had, if you go over to our dividend calculator, Y mag on Friday gave us, boom, 19 cents. 19 cents on 1820. So we're going to come in here and we're going to say 19 cents. I have to use my calculator because I don't have that in there for me. How many shares do we have? YMAG. YMAG shares. How many shares do we have? We have remaining. Where's my number of shares? Dividends. That's way over here. Oh, it's off the screen. Shares holding. So we are holding 2,663 shares. So 2,663 shares times, what did we say? 19 cents. 0.19 equals, that's $505. $505. And we got that because we have $50,000 in there. So we got to come down here. Oh, now I forgot the date. I think it was just last Friday. January 30th. So January 30th on YMAX, 1/30/2025, we got $505.97. Okay, and you notice that I updated the spreadsheet. So I think this is in the new spreadsheet. Today, Pit News Magazine comes out, and you get the new spreadsheets with Pit News Magazine. You'll get the link. If you got the link, you already have the new spreadsheet because I posted the new spreadsheet. So these tables are now all built out in here. See this? This is your seed money down here, seed money tables, and these are your dividend tables in here. So now these are all calculated. So notice that this is no longer a green table. This is no longer a green table. And so what happens is these just pull from, I think, yep, they just pull from down here. So all you have to do is just put in your dividends that come in here, and it automatically populates your spreadsheet up here. That's very cool. So now I put in this one here, $505. It automatically added it to our payment received. E30, see, that's 15. Oh, right there, 1547 right there. See, that's the same number. And that gives you all of your calculations. We got paybacks years left, 2.16. We'll have our entire $50,000 back. And then we'll have a cash cow and we'll be on the gravy train. How about that? Pretty damn cool if you ask me. All right, let's go into the next one. YMAX. Let's go to YMAX. How many shares do we have? We have 3,000 shares. Let's go see how many dollars they gave us. YMAX. YMAX gave us 14.7 cents. So we'll just put that number right in right now, 0.147. And then we're going to go over How many shares? 3,006. 3,006. Oops. Times 3,006.61. $442. So we got to come down here. YMAX. 130, 2025. That's 130. 130, dude. 0. There you go. And the dividend was $442.87. Boom. Just like that. Okay. So that means so far we've got some cash in here. Let's put our cash in here. We got $505.97. Oh, we got to do equal sign. Equals $505.97 plus $442.87. The stock market goes up, we'll make more money. If the stock market goes down, we make less money. Kind of weird how that happens, but you still make money. That's pretty cool. All right, so did we get paid on NVIDIA? Bang, that's our money, $948. That's pretty good for having a market go down. Let's go over and look at NVIDIA. Did they pay off? Oh, wrong one. How come I can't do this? NVIDIA and NVDY. NVIDIA. All right, we did get paid on the 30th, 82.9. So let's put that number into our calculator here. 8. Of course, if you're doing this in your real money account, these numbers are all calculated for you, and all you have to do is just type them in. You don't have to do the math. 0.829. 829 times how many shares do we have? Shares. NVIDIA, number of shares, 1,450 times 1,450. $1,202. That's a nice tidy little income for us today. 130, 1-30-2025. 1202.05. Boom. Just like that. Now we got to come over here and add plus 1202.05. Bang. Just like that. Now we're up $2,150 today. What about Tesla? Did they pay us? TSLY. TSLY. Bang. Did we get paid? We did on January 23rd. Did we already report that one, though? That one was January 23rd. Tesla. Well, we didn't because we got nothing on Tesla. January 23rd. 0123-2025. We got how much? Let's go look again. We got 71 cents, 0.717 times how many shares do we have of Tesla? Tesla, all the way over to number of shares. Oh, where'd you go? Shares. Wait a second. I think I did this wrong. I did 1,450 shares. That's monthly income. I got to do this over again. I don't think we made $2,600 on there. I've screwed up. What about that one? I think we did that one right. This one we did right. Let's 1750.7 equals. I grabbed the wrong number for that other one. 1255. So this one is 1255.25. Bang. That's a good income for us. Let's go back and do this one again because I think I did it wrong on NVIDIA. I hate when I have to do things twice. NVIDIA. NVDY. So NVIDIA, we got, put that number in there, 829, clear, 0.829 times number of shares, Lan. Number of shares, 1,128.16. 1,128.16 equals 935. You tried to cheat. 935.24. Bang. Okay. All right. So now we get to come over here. And in here, we got to get rid of this number because that was a bogus number. 935.24 plus our Tesla 1255.25. Enter. $3,139. What are we going to do with that? We got any more? No. We could take this and reinvest it and make more money next time. Let's say we had $3,000 in Tesla. If we'd had $3,000 in Tesla, 3,139, how many shares would that be? Let's go over and look. So we could do 3,139 divided by, what's Tesla trading at? 1822, 18.22 equals, that would be 172 shares. So if we had 172 shares, 172 times, and we got paid out at a rate of 829.829 equals $142. So if we take our money, our $3,132, and we put it back into Tesla, next payday, we'll get an extra $142 every month after that. So over a year's period of time, it'd be $1,400 more. Do we want to do that, or do we want to go buy something? Depends. Way, maybe we want to go buy something. We've been buying things, but this is my old portfolio and I don't have anything in here. Legacy portfolio, we bought a four-wheeler. Oh, we didn't buy those. Traditional dividend. I think we actually did. I think I started over. Sorry, guys. I started over when I got this new calculator. I don't have anything to buy. Legacy. We had a four-wheeler, motorcycle, Tesla, and a wife's present. We actually spent some money on a wife's present. We bought a bunch of stuff, but we also reinvested. But then I think I reset all this. So I reset it to 50,000, 50,000, 25,000, 25,000. And look at the payback. Years left. 1.13 on Tesla and 1.30 on NVIDIA. So it's going to take them 1.3 years or 15 months, 15.6. It says 16 months to give us our $25,000 back. So we're going to double our money in 1.3 months, 1.3 years. Usually they say, what, 7 years to double your money? That's pretty good. It's like smoking all the other investments. That's why I love these. Look, even this one here, YMAGs, $50,000. It's going to only take it 2 years to give you all your $50,000 back. And then it's a cash cow. It's cash cow. It's a cash cow. And then you're on the gravy train. Question is, what do we want to do with that $3,000? Do we want to go buy things with it? We could go spend it on a four-wheeler. We could go buy stuff. Don't we want to buy stuff? Or do we want to just reinvest it? Things to buy. Holly said, don't spend it. Go reinvest it. But isn't that why you make money, to go spend it? We made $3,000 today. Yeah, but I want to make more. We'd put the seed money in here. If we took the 3,000 out here, let's say we put 3,000 back into Tesla, we would put it right there. And then that would increase that number there, which would then reflect up here in this number here, which would then all calculate out for the next time. And we would have more shares. Because we'd have to calculate how many shares we had if we did that. Right? Increase our share quantity. Okay, don't forget to do that, because if you don't update the spreadsheet properly, it's not going to work. All right, we'll decide. I'm not going to decide today what to do with that $3,000. I'm just going to give you a Sunday school lesson, and we're going to call it a day. All right, here's your Sunday school lesson for the day. What are the fundamentals? News, weather, government reports, earnings, pandemic like coronavirus, etc. The fundamentals drive the long-term trends, right? It's the technicals that drive the short-term trends. What's the technicals? Well, that's all the stuff we did today on our stocks, right? We were drawing trend lines. We were looking at probabilities, statements, A1s, B1s, C1s, X1s, X2s, X3s. All that stuff is the technical analysis. That's mathematically modeling out our stocks. So we want to do that. And even on these, when we reinvest, let's say we want to reinvest. If we wanted to reinvest in Tesla, would we go and just dump it in today because we got it today? No, we want to be very systematic about reinvesting our money back into these markets because you want to put it into buy low, sell high. So buy low, sell high. So that's why I never automatically reinvest my dividends. I always put it into cash, and then I can take some time to go and decide where I want to strategically put that money back into the market if that's what I want to do, or I can go spend it, whichever. But if I'm going to go put it back into the market, I don't want to just randomly throw it back in on the day that I received it. That's stupid. Why would you do that? Well, because that's the way the software does it. That's auto reinvest. Okay, so what? Just because they give you a feature doesn't mean you have to use it. Because it's a stupid feature. Think about it. Logic. You want to be smart about your reinvestments. They give it to you in Tesla. Doesn't mean you have to put it back into Tesla. You can go put it into NVIDIA, or you can go put it into Microsoft, or you can go put it into FBY, Facebook, whichever one's at the best buy low, sell high region, at the accumulation stage. So be very wise about your reinvesting of your dividends. If you get a big chunk of dividends, we got $3,000 we got to put back in. Just because we got it from Tesla doesn't mean we have to put it back into Tesla. Remember, the fundamentals drive the long-term trends. It's the technicals that drive the short-term trends. So that's why we spent some time thinking about today the fundamentals of what the tariffs are going to do, which markets are going to take advantage of that, which ones aren't. We're trading the fundamentals. But then we also look at the technicals. Where are these things at as far as the Fibonacci retracement, projections, all that kind of stuff, Elliott waves, 3-drive patterns, probabilities. And then we meld those two together and you get a 1, 2, 3 knockout punch. All right, guys, that's it. That's all I got for you today. If you haven't gone in and gotten your Pit News magazine, you need to do that because today's Pit News magazine comes out today. I'm going to go release it as soon as we get done here. I'm going to go work on Pit News magazine, get that out to you, send you an email. And if you have not got into Pit News magazine, you need to get it because today's version is worth the entire year's season just for this one issue. You need this one issue. This is the greatest issue we've put out all year. It talks about all the stuff that I just did, all the ROC stuff, all the return on capital, all these stocks, all this stuff that we're doing here. It's all in this issue. It's all there. It's just all there. Okay. So I'm going to let you on the way out, let Claire tell you about Pit News Magazine, how you can get it for half off. And then we will catch you guys tomorrow afternoon for Power Hour so that we can day trade together. Take care. See you guys.
Hey everyone, it's Claire here. Are you ready to take your trading knowledge to the next level? Welcome to Pit News Magazine, your trusted source for trading intelligence. Whether you're a seasoned trader or just starting out, this magazine delivers the insights you need to stay ahead of the market. Featuring articles from experts like Dr. Scott Brown, Aidan Gray, myself, and of course Mr. Lan Turner. Pit News brings you exclusive strategies, deep dives into market psychology, and powerful trading techniques. Find out about the exponential power of growth, seasonal trading secrets, and even Lan's latest wild eye, crazy eye iron butterfly strategy. Each issue is packed with expert trading strategies, top stock picks, key seasonal trading insights, and comprehensive analysis of commodity futures and ETFs. You'll also find tips on technical analysis, option strategies, and much more. No matter your trading interests, we've got you covered. And the best part? You can learn your way. Listen to each recorded article, read the full in-depth lessons, or watch our video breakdowns. It's trading education on your terms. Right now, we're offering a special deal. Get your first full year of Pit News for only $19.97. That's 50% off the regular price. 12 issues of powerful trading insights, backed by our 100% satisfaction guarantee. So, don't miss out on this limited time offer. Head to pitnews.com and subscribe today. Empower yourself, enrich your trading strategies, and stay informed with Pitt News Magazine. Trading intelligence right at your fingertips. Okay, let's get back to Mr. Turner. Thanks for sticking with me.